My guest today is Joel Mathew. Joel is a head of originations in a private equity firm called Woodson Equity, where they acquire lower middle market companies. Today, they have a portfolio of 4 companies. Thanks a lot for coming to the podcast.
Of course. Thanks for having me, Mick.
Joel, you're an excellent person to talk to. You lead the pursuit of new acquisition opportunities as, again, head of originations, leveraging your entrepreneurial background and deep expertise in business development. Before getting into all that, your journey as an entrepreneur, can you tell us about your story into the world of private equity and what led you to become an entrepreneur?
Yeah, I can definitely do that. And I would say the opposite is it's not my private equity journey that led me to be an entrepreneur. It was actually my entrepreneurial journey that led me to be in private equity. I would say even from me looking back to being 10, 11 years old, I always looked up to and admired my older cousins and other family members who are entrepreneurs and charting their own path and creating their own companies and taking control of their futures. And so for me, even from a young age, I knew that's what I wanted to do. I just didn't know what the offering was or what I wanted to, the problem I wanted to solve. And I didn't really learn that until I got out into the media world after college and after studying and spending 7 years in the media here in Chicago, and until I really the light bulb moment for clicked of what problem I wanted to solve, and that was 15 years ago. And fast forward to today, have founded multiple companies that have been handed to the management teams to run the day-to-day operations, and now sitting in the head of origination seat at Woodson. So now I get to go and hunt for our next acquisition, which is something that really excites me and fires me up.
Okay, and maybe you can share some of the maybe ideas or thoughts or why you decided to move on with Woodson and not just run those companies, so-called, if you can say, like independently, and just focus all on that instead of just moving forward to a new opportunity.
Yeah. I have always been wired very opportunistically, not surprising for the seat that I'm in. For me, in my first company that I started 15 years ago with an agency here in Chicago called Fortress, I would have all these strategic partnerships or all of these deals that would come to the table saying, hey, I'll give you X% equity and help me with this, or come alongside me on this, building this company. And so for me, I didn't really have the expertise in how to structure those deals and get those over the finish line. So I actually hired an executive coach 2 years ago who was going to help me structure some of those deals and build out the term sheets and help me build this own portfolio where my joke is I got kind of slapped on the wrist by a couple of our CFOs where they're like, you can't do these deals because you own a lot of companies that are worth nothing. So it had to be structured properly. So I brought in an executive coach to help me who specialized in M&A, and so he helped me structure some of those deals when I was an agency owner. And so that just got me really fired up on like what this M&A and acquisition landscape looked like. And so we completed our first acquisition as an agency in 2020. We acquired another agency. So that helped me understand the process, understand the integration of rolling up another agency into Fortress. And so that's where really this fired up. And you'll hear me mention Vijay Moni, our managing partner and founder at Woodson, many times during this. But he and I have been friends for 25 years. And I went the entrepreneurial path in life. He went the private equity path in life. And so we always, work together in various capacities. And so, getting to see his journey as well of growing, several firms to crazy heights was really eye-opening for me and really fired me up.
And what was the initial idea for you guys? Because you have Subir on your team as well. Like, what was the early conversations that we should maybe work together as we know each other for such a long time? What was the thesis?
Yeah, so and Sabir also, we've known each other for a very long time, and so the thesis was pretty straightforward, and it's to be more thesis driven, right? So it's like in LA, Vijay says the landscape in private equity in New York is very structured, very regimented, very systematic. In LA, it's more that big dream, I don't want to say like cowboy type of structure, but it's like that dreaming big, almost like that Hollywood effect. But then, our goal at Woodson is to take that diligence and hard work and intelligence from New York private equity or East Coast private equity into that whole dreaming big, opportunistic thinking, of West Coast private equity and to roll it all into one and to do it differently. And so for us, very thesis driven and mission minded. And so, we're not trying to be generalists. We're not trying to be everything to everybody. And, we very much focus, what we always say is we're an inch wide and a mile deep. We focus in sectors that we have deep expertise in-house. And so that's where we like to play. And so that's really where Woodson was born. My joke whenever I'm talking to an investment bank, it's just that we are the owners and entrepreneurs and operators, and we have the finance guys on our team that can help with that side of the house, versus a lot of PE is wired the opposite, where they're the finance guys and financial engineering, and then they figure out the operation. So we're very much operationally driven and entrepreneurial driven. Every single person on our team, our founding team, has owned or operated multiple companies even before we came together as Woodson.
And how do you structure it all, if you can share? You have your companies you've founded, you made acquisitions, and your partners have different background. How do you structure it all so it's all under, if it is all under one umbrella, or how does it work?
Yeah, every deal is set up in a different way. It really just it's kind of depends on the deal, and so that's what I can say on that. But yeah, our current portfolio, you set up the entity, and that's run. There's certain corporate structure and governance that we have set up, but every deal dynamic is a little bit different.
And when it comes to the holding period, what is your idea when it comes to, or what is your team's idea when it comes to following this long-term buy and hold strategy versus buying the business, building it, growing it, and selling it in 5 to 7 years?
Yeah, so our typical hold will be anywhere from 4 to 6 years. So, call that 5 years. But ultimately, it's going to largely be dictated by how the company's performing, and then just market conditions as well. So, could be sooner, could be later, but generally on average, it's going to be our horizon is going to be around in that 4 to 6 year range.
And you talked a little bit about the businesses, the expertise. So what are you looking for today, and what is your potential opportunity you see, let's say, tomorrow, and you get really excited about?
Are you asking as far as sectors or profiles of certain companies?
Profiles of a certain company, size-wise?
Yeah, size-wise, revenues, we're looking at 75 million and up. EBITDA, we're looking at 6 million and up. And sectors, when we started the firm 3 years ago, we had a few more sectors that we were pursuing, and that was based on various capacity and various capabilities at the time. But then every year it's gotten more and more niched down into just where we are today, which is just our focus is on diversified industrials and its business services. And that's where we feel like we have the most in-house expertise and firepower, and where we can transform the company in the quickest amount of time.
Why this size? Why not smaller? Why not larger?
For me, giving you an example of on the agency side, we could do a $100,000 project and we could do a $20,000 project, and the $20,000 project is not 1/5 of the work of the $100,000 project. So for us, the logic is be patient and pick our spots where we can have the most upside. Obviously, you're going to have a better return and a better outcome on a larger deal. And so, the effort it takes to close a deal that is sub 10 million in EBITDA is going to be not going to be proportional to closing something that is 10 or 15 or 20. So for us, we'd rather stay in our lane and stay disciplined with what we're focusing on, versus just chasing anything and everything. And there is that pressure to get a deal done and get deals done, but we want to make sure we're using our resources wisely. And a word that comes up all the time for us is being a good steward of our internal resources, but also when we're in a portfolio company or looking to acquire a company, we want to be a good steward of their company and their brand and their resources, and help them get to that next grow to that next level.
And when it comes to those portfolio companies, is the idea to build a platform roll up, or it's just to go like a diversified portfolio of different businesses?
It's a little bit of all of that. So, we're going to have our platforms, we're going to have bolt-ons to those, and then ultimately it's going to be a diversified portfolio in a few different lanes, but it's all going to be in the subset of diversified industrials and business services.
Now, when it comes to your expertise and what you've done before, how does Woodson Equity add value to its portfolio companies beyond capital investment?
Yeah, I think it's a great question. And it's not enough for us to just go and put money in and then hope for the best. And that's why all of our investments are control investments. And so we want to be in the trenches operating the business. And so I'll give you the First Source Electronics example. It's a deal that we closed, a complex corporate carve out from a public company that we closed the deal in 35 days and was handed the keys last October, November. And then now we've completed the first 100 days and off the TSA, and things are going according to plan. And that goes to working a certain plan, setting a certain project management office and operation, and then having a strict plan and being diligent around working that. Our people are at the facility, and this is kind of a unicorn deal for us because both our managing partner and our head of operations are in Virginia, and this company's in Baltimore, so there's some proximity where we can be there. So they set up beds at the facility, and not to go total like Elon Musk style, but like the guys sleep there, a couple times a week just because they want to be there when the first shift starts at 6 a.m. and want to be present and visible. And so I think it's coming alongside the management teams, and it's allowing them to make decisions and go faster and empower them versus being handcuffs and bureaucracy and red tape. So we want to be there not to be micromanagers, but we want to be there to help solve problems and help our teams go faster. So for us, it's when we say we're hands-on operators, like it is really not just lip service. It's really true. So I think part of it is just getting people in the right seat, and the right people in the right seat, and then allowing them to go faster, and then always providing them with resources and guidance, and pushing them in the right direction.
I forgot to ask in the beginning, your core team, what are the roles and maybe what are the strengths and weaknesses between you three?
So what we say is there's three legs to the Woodson stool. One is M&A execution, which Vijay Moni, our founder and managing partner, heads up. There's Originations, which is the deal sourcing and going on the pursuit of our next acquisition, which I lead. And then there's the operations stool, or leg of the stool, which Subir currently leads. So we have a really good balance, I think, of, I was thinking about this on the drive into the office today. It's just, you have me who kind of errs on the side of optimism and positivity of like the upside and the opportunistic approach. You have Subir, who's more of that engineering project manager background, who's like very systematic in how he looks at things. And then you have Vijay kind of in the middle, who's that pragmatic and very realist on what can be done and what the story is. But yeah, I mean, strengths and weaknesses, I think we all play off each other really well. And I think, we can keep each other focused and motivated when needed. And, we're all friends outside of this as well. So for us, this doesn't feel like work or business. It's like we're going out and getting to do this.
Hey, a quick pause from the episode. I want to talk about a very special sponsor, CapitalBat. So this episode is for people wanting to buy a business or wanting to invest in businesses. So CapitalBat is the place where they meet. CapitalBat is the SMB investment platform that connects accredited investors with acquisition entrepreneurs. All that so more great small businesses end up in the hands of capable operators. If you're an investor yourself, you'll see curated opportunities with clear thesis, incentives aligned, and real operators at the helm. But if you're a searcher, you'll find capital partners who understand rate environments, covenants, and the grind of year one. Deals move faster when the right people find each other, and that's why we have CapitalBat sponsoring this episode. This is for accredited investors and acquisition entrepreneurs only. Nothing here is investment advice. You have to do your own diligence. So if you want to learn more about CapitalBat, go to capitalbat.com. I'll also put the link in the show notes so you'll find it easier. So again, capitalbat.com. And now back to the show. Can you share more stories about other portfolio companies, the idea behind the investment, how has it been, and some of the changes you've made?
Yeah. I mean, I'll go back to First Source Electronics, and I think it's just going back to that stewardship concept of every dollar should have a purpose or have an impact, and easy to spend money when it's not yours and nobody's paying attention to it. So I think it all goes down to paying attention to the numbers and paying attention to the operations. And so for us, getting into that company and being handed the keys to that company, we realize what they're spending, spending money on. It's $2,000 a month on K-cups for the coffee machine. It's $4,000 in floor mats. It's $20,000 a month in waste management. And when all of these things can be streamlined. So for us, it's a matter of getting in the company and then analyzing not just what costs we can cut, but it's what is truly needed for the business, and then really leaning in there, and then making the investments, into systems and other technologies and people that are going to help us accelerate.
Now I know this interview will go all different routes. So now I would like to ask a few questions about like looking beyond P&L. Like you've said, most investors just focus on the P&L. What are the overlooked intangibles you try to surface in intelligence that others may miss?
Yeah, I think a lot of it goes to those site visits and those management presentations where you try to understand chemistry with the management teams and with the leaders. And then you also try to understand culture too. You can see that and on a factory floor, and that's not going to be in any data room when you're being presented a company. Is like, there can be smiling pictures in the deck, but like what is the culture like? What is the morale like at any company? And are people excited to be there? Are they happy? Are they working together? Are they collaborating? Or is it just very siloed, very monotonous, just doom and gloom, get in, get out? So those are some of the intangibles. I think I would say culture is big when we're doing our site visits and when we're going to different locations. And then I think chemistry with the management team, like, is this somebody that if they called you at 8 p.m. or 9 p.m. on a weekday, or they called you at 7 a.m. on a Saturday morning, is this somebody that you're excited to talk to and excited to help, or do you dread picking up the phone call? And so for us, like, a lot goes to chemistry and culture, I think, are some of the intangibles. And some of that stuff you can't really tell, right off the bat. Sometimes you have a gut reaction, and sometimes you have to do more diligence and more digging and spend more time with people and at these facilities to understand the true picture.
Now I did some research. Vijay had some YouTube videos, and he was mentioning again, as you said, culture, purpose. So my question may be, how do you weigh purpose when evaluating businesses that might be financially solid, but culturally not so great?
I think it's in spending time with the leadership and understanding like what their dreams are, right? So it's like, I wish we could do this if we had the resources, or if we had the talent, or we had the knowledge to do X, Y, or Z. I would love to do this. And so it's almost like understanding the dreams or that wish list of what can be done. So spending time, I think, is really important. And anybody can, show well on a 30-minute Zoom or on a management presentation, but like, we try to do the management team dinners or the management team lunches where we can go and get outside of the office and really get to know each other on a personal level and understand personality types and understand what motivates them and what their vision is and what their dream is. And I think that helps us understand more of the purpose versus just, hey, I'm here to finish this transaction and I'm here to grow this from, 2x to 5x or whatever that looks like.
Now it takes a lot of time to have those management team lunches, dinners, building those relationships. Do you have like any statistics when it comes to how often, number one, do you walk away because of various reasons? And maybe you can mention like what have been some of the reasons you decided not to move forward.
Yeah, it's a good question. And so for us, there's some level of volume that we go for as far as deals that we like to see, and or number of deals we want to see it rather. And so for us, we want to see over 1,000 deals a year, and that's what my personal goal is, to see over 1,000 deals per year. And then ultimately, obviously with a lean team or a version 1.0 of our team, we have to be very selective and very disciplined with where we're spending our time. Like, we can't go deep and analyze every single deal that comes across our plate. And that's why we're focused on diversified industrials and business services. And so this is where we have expertise. This is where we can give a quick read on the deal and see if it's a good deal or if it's a Woodson deal or not a Woodson deal. And so for us, we can give a quick read and we can lean in quickly and learn more, or it's a quick pass for us. But the majority of deals are not going to be a fit for us. And that's okay.
Another video by VJ on YouTube where the title is Woodson Equity Hands-on Operators and the Importance of a Story. And you've said that every company has a story and it's your job to uncover it. How do you distinguish between a good story and a great one and one which is like worth investing in, and how do you really make a difference there? Because everyone has a story.
Yeah, definitely. I think it goes back to your question on purpose of, are we here to just build wire harnesses, or are we here to just build solenoids, or are we here because we are an integral part of the automotive supply chain or critical infrastructure? So I think it's understanding, it's up to us to also pull that out too, because a lot of the people that we are meeting with, they're not natural, like, they visionaries or storytellers to a degree. So it's also up to us to see it, sometimes even before they do, and uncover that. So, I think it's tying them into that wider picture, that, that bigger purpose, and having them zoom out as far as what they do. And so I think that part of it is just tying that back into purpose of, the story is really just telling the purpose, I think.
And when you're comparing like great storytellers versus actual businesses which are doing very, very well, like how often do you see that the story is actually much better, stronger than the real numbers behind this?
I would say it's pretty rare, and we're blessed to be in a couple of deals right now where we've seen that, and we uncover this potential or this upside that maybe they don't see. But there is the opposite side of that too, where it's more of the story and this sizzle versus, like, the numbers will tell the story, and the numbers will ultimately dictate what we do or what we don't do. But you have lots of people that can sell and tell stories and things like that, but ultimately the data is going to prove it right or wrong. But the flip side of that is sometimes, the data doesn't always show all of the upside or all of the potential opportunity for us in any given deal.
Now, when it comes to on being hands-on operators, what's something you've learned from spending time on the factory floor that would be invisible in a data room, if we can say that?
Yeah, I mean, I think it goes back to that question of culture and morale. You don't see any of those details in a data room, and I think you can feel it of what culture has been built, and also it's really important for us to establish that in one of our acquisitions of, this is now a family business. We're going to let this thing fly. There's no red tape. There's no bureaucracy. There's no handcuffs here. Like, we want to empower people and put the right people in the right seat. So, for us, it's a matter of allowing people to really flourish and thrive.
Now, when it comes to those portfolio companies, I guess it's always the case when you're like spending time on the factory floor. And why I'm asking is like, how do you make sure that this operational insights from the ground level actually make it into a board level decisions and to your head office?
Yeah, everything goes down to reporting and data and metrics. Like, everything has to go into an annual operating plan, and then we have to work the plan and work backwards from there. Everything, it's we may implement certain things, but and we may make certain bets on certain initiatives at any of our portfolio companies, but ultimately it goes back to the data of, like, did this increase sales? Did this increase margin? Did this increase efficiency or output? On-time delivery? Like, what was the output of this? And so everything is tracked, and it goes back to what I touched on earlier of this whole project management office that we set up, and every single process of the company is listed, and there's an owner, there's a primary internal owner, there's a primary external owner, at Woodson, and so there's certain responsibility, and so that also goes into the reporting as well. So everything is reported on, every single step, every single process is documented and reported on. So for us, it becomes very systematic. There's no guesswork. It's just, here's the plan, here's who's responsible, and then working the plan, and then reporting on our progress to that plan.
Now, when it comes to changes post-acquisitions, it's oftentimes said that private equity, they often like make the most changes post-acquisition. Like, how has it been in your case? Like, how often do you need to let people go, and how happy are you? Obviously, you're not happy doing this, but how often do you actually do this when doing those deals?
So our mentality going in is never to just go and cut a bunch of staff and just do that right off the bat without some level of thinking or strategy around it. And so I think it goes back to the first 100 days. And so us laying out the first 100-day plan and then seeing who can keep up at that pace. And so sometimes there's a self-selection process where people are like, hey, this was good for a while. I don't think I'm ready for this under new ownership, and I don't think I'm ready to operate at this speed. And so sometimes there's a self-selection process out. And then, that first 100-day process is really meant to show who can step up and lead and take on more responsibility, or who can kind of shine. And then it'll also show who cannot keep up. And so for us, then it becomes more clear who should stay and who should go. And so, everybody talks about cutting staff, and, obviously that's or reducing headcount, and that's, part of the industry. But I would also say the flip side of that is how we help empower people who maybe are talented but not deploying their talents as much as they could. We try to uncover those people and put them in leadership positions and in management positions too, so that they can have more influence. And they're great culture fits, they're diligent, they're hardworking, and they're smart, but maybe they're in a position where they're not utilizing all of those tools. And so we want to promote and empower those types of employees as well.
When it comes to your day-to-day job, Originations, I would like to understand the strategy and the process. Maybe starting with, what is the most misunderstood aspect of sourcing private equity deals?
I've been in business development or originations in a variety of industries, and I would say in my entrepreneurial path over the past 15 years, a lot of it boils down to developing business and bringing in new business. And I think that, personally, I think the greatest CEOs are ones that can sell and can close deals and, develop partnerships and strategies that way. The biggest misconception, I think, is that it's difficult to source deals. I actually think the opposite. I think it's pretty easy, because it's a lot of work, but that doesn't necessarily make it hard. I think that this is one rare industry where there's truly mutual benefit. Like, we want to buy companies, the bankers want to sell companies. It's a true win-win for everybody involved. And even if it's a private seller, like, they have a potential life-changing sale that we can be a part of. So what I've found, which has been surprising, is you have a lot of people that are willing and open to discussing what the opportunities look like, but it does take a lot of work. It takes a lot of diligence. It takes a lot of time to stay top of mind and stay constantly in front of bankers and corporates and proprietary deal sources and everybody in between. So it takes constant diligence. It takes constant activity. There's no time to rest. But I would say that it's easier to make that connection and get to that deal flow than one would expect. And you're dealing with some of the smartest people in Harvard, Yale, MBAs, and some of the smartest people who have gone through rigorous things in their career to get to where they're at. And I think a surprise for me is just how relational they can be. And so there's a certain balancing act between this being transactional and being relational. So I think you have to balance both of those things. But yeah, I would say that the vast majority, I would probably say 99% of people that we've met have been very open to discussing. And I think that it also goes back to VJ and his history in private equity over the past 15 years of just really trying to be courteous, be professional, and always be kind to people, and do business a little bit differently than traditional private equity.
Hey, one more quick break, because I want to talk about another very special sponsor of this episode, Spacebar Studios. So if you're running a company, an investment firm, you need trust, you need deal flow, and you need talent coming to you. That's where Spacebar Studios comes in. They're a done-for-you newsletter service for different companies. They take care of the strategy, writing, design, and even the distribution. Imagine a crisp weekly or monthly update that makes sellers forward your name, LPs feel informed, customers remember you, and candidates want to work with you. No more the bad feeling that we should write more. Spacebar turns your insights into consistent, compounding attention. They have a great team. The company is founded by two guys, David and Brandon, very smart marketers. And if you click the link today, or if you go to spacebarstudios.co and you book a free call with them, you will get the first few emails own the house for free. So again, go book a call, spacebarstudios.co, or click the link in the show notes. And whenever you have the call, tell them that Mick or Holdco Builders or private equity guy sent you. Now, back to the show. I haven't had too many guests who are chasing deals which are larger than 75 million in revenue and 6 million EBITDA. My question to you, and again, based on your previous experience, how different is the game on, if we can say, on such level versus smaller deals? For example, 5 million in sales, 1 million EBITDA. How different is the game?
I think it's very different. I mean, I still see some of those smaller deals that are, 5 million top line, 1 million EBITDA. I'll see those, but there's a certain level of professionalization that's happened to get that company to 5 million EBITDA, 10 million EBITDA and up. I think you have a more sophisticated, in general, you have a more sophisticated seller. Not always. I mean, it's pretty amazing. Like I've encountered plenty of companies that are, 100 million in top line plus, and it's really just one guy who's built a nice family business and has one, salesperson and one guy leading his ops, and his niece is the bookkeeper and the controller. And so there is a big difference, I think, in the overall management team for a company that's much larger. And, the saying is like the team that takes you to a certain point is not necessarily the team that's going to get you to that next level. So the companies that we're looking at generally have a pretty strong structure as far as management team goes. They have they definitely have viability, and then they have some level of market share. They're either a market leader or they have a significant market share. And that's a big difference between some of those smaller guys who are just, hey, we got to 1 million EBITDA. You don't need to be a market leader or have the majority market share to do that. So I would say that's the difference in that smaller buyer versus where we're at. And then there's, we're considered lower middle market, and, there's ranges to that. So, there's a whole higher level, there's a higher level than that as well.
And when it comes to those deals, do you look and prefer those family businesses, or you buy from PE firms, or what type of deals?
That's a good question. And we've seen deals that are private sellers. We've seen deals that are run by private equity or owned by private equity. We've seen lots of deals that are corporate carve-outs and divestitures. We love the corporate carve-outs and divestitures just because there's motivation on all sides, for a clean break, and we can stand it up. And I would say less emotions involved. But for us, it doesn't matter so much as far as like whether it's a private seller or owned by PE, as long as there's upside for us and there's an exit path. So what professionalization has been done or has yet to be done is something that we look at, and then ultimately understanding exit path as well. So that's one screen for us on deals is, this is a great company. We could buy it and hold it and run it forever, but that doesn't really fit within our thesis. So for us, we always have to understand, or at least have to have some idea on what exit path looks like.
At this level, do you look or do you chase any like off-market deals, or you don't do it at all?
Absolutely. Yeah, absolutely. And there's 3 lanes to what my focus is. One is really working with investment banks and understanding their processes and getting into the processes. And then the second lane is direct to corporates and understanding assets and divisions that may be underperforming and that may make sense to carve out or divest. And then the third lane is really that proprietary or off-market deal, that may be somebody who's at a wealth management firm or an accounting firm or a law firm may have access to, that we want to be a part of. And so for us, it just becomes the competitiveness as well. It's like, do we want to be in a process with 50 other firms, or do we want to be in a process where we're the main horse, or maybe there's three other parties? So for us, the odds are better for proprietary and off market.
Now, if you can share some secret sauce, how do you build trust with those founders who weren't looking to sell at this stage?
I think very quickly they see that we do it a little bit differently, and that we're not just the financial engineers that come in and nothing wrong with that, but they'll see that we're trying to build these companies and that we have a certain level of care and attention that we give to our companies that is not really seen. And I think based on previous experiences of what we've done at companies, gives a lot of comfort. But I think ultimately the answer to your question is really patience. It's you can't force somebody to be ready to sell or to sell. I mean, maybe you can with the right showing up with the right amount of money, but overall, I think patience really wins, and they have to be ready for it. You have to be the resource, and it takes diligence. It's not like you pick up the phone once and that person never contemplated a sale and then they're going to sell their company. It's more we always view things as a long game. So it's being patient, but it's also being diligent with staying top of mind and saying, hey, when you're ready, we would love to chat or be a resource. So I think patience wins with that.
What else is different? Like, I mean, comparing to other firms, let's say there is a great company run by what you said before, one guy, his family members are involved, but they're tired. They would like to make this great exit to a even better firm. So one thing you mentioned is the patience. Anything else? If there are like 4 or 5 guys like you talking to him, like what's something you would bring out maybe?
I think the growth story is one that people get really excited about in uncovering new projects or new products and new services and helping them just think differently. I have so many conversations where people realize they're like, this is as far as I can take this business. I need some outside, brain power and firepower and talent to help this get from a $75 million company to a 250 to a 500 to a 750. And so people are surprisingly self-aware of their limitations. And then you have others that are delusional that think they can do everything. And then, there's good and bad to both. But I've seen that people really get fired up about our track record and what we've done in other companies and in previous chapters in our career as well. And I think that it looks different, it sounds different, it feels different than the conversations that they're probably having with 5 to 50 other parties.
How much do they appreciate the fact that you've been entrepreneur yourself before you do all this now?
Yeah, I think that's been the main thing that has been a differentiator, because anybody can talk about their track record or their returns, but how many of those people are sleeping at the factory and on the factory floor, or how many of those people are actually in the communities doing work. And I'll give you a story. This was never publicized. This was never a social media post. This was never in a newsletter blast, but somebody at one of our companies, an older lady, her apartment building burned down. And, it was our not just like our team, but like our chief of staff, and our core team at Woodson that was there, helping her move, giving her temporary housing, not just for her, but for her cat also, getting her furniture, helping her move back into into her new place and helping her, support her during that time. And, that's not stuff that rightfully so, like we don't publicize that stuff, but that's just what we feel is the right thing to do. And that's what we do, and not for any kudos or praise, but that's the way that we try to take care of our people and, truly think of it as a family.
When it comes to today's market, in your opinion and in your experience, where do the best like off-market deals come from? Is it like some type of events, conferences, masterminds? How does it work?
Yeah, I think the best off-market deals are going to come from a variety of sources, but it goes back to that originations activity where you have to stay active and you have to stay diligent. But I think it can come from conferences. I think it can come from various industry events. For us, it's going to a industrials conference, or it's a industrial chamber of commerce, or it's a matter of connecting with local law firms who have high net worth individuals or business leaders who may be contemplating an exit, where we can provide a solution. Or it's going to that accounting firm that is managing the books for a company that's growing and that may be worthwhile conversation to have as far as acquisition or exit. So it comes from a variety of sources, but there is no just one source. You have to stay plugged into a variety of organizations. You have to hit up a variety of events, and then ultimately you have to stay top of mind with people. And with off-market and proprietary deals, it's really the long game. Occasionally you'll come across somebody that's like, hey, I know this guy who wants to sell his business. You should talk to him. But most of the times it's not. It's a much longer term play.
Now, when it comes to your best use of your time, it takes a lot of time to just fly to other city to attend to a conference, even though there are maybe could be 5, 10, 15 different types of companies who would like to have a conversation with. If you think about your time today, what is the best use of time for what you do?
Yeah, I think that's a really good question, and that's a constant struggle. It's where are you spending your time to get the best return, and you have to be a good steward of your time, and you have to be disciplined and diligent, and otherwise there's too much to do, and the to-do list piles up, and you haven't gotten enough done. So I think for me personally, it's a matter of really focused time in different spurts, and you're obviously always going to have the fires to put out. You're always going to have the challenges that come up, day to day, but it's really being focused on what's going to give you the most return on investment. So for me, it's blocking out certain time, like this is my outreach time, or this is my follow-up time, or this is my deal analysis time of understanding the market and understanding our read on a certain deal. So I think for me, time blocking and ultimately, where we're at as operators, it's this kind of symphony of balancing hunting for the next acquisition and managing our current portfolio companies. And so we have to strike that balance between doing both. Like we can't, if we focus too much on the portfolio, our own outsource or our own process for BD is going to, and our own Woodson operations is going to suffer. And then if we focus too much on our Woodson, outreach and efforts, our portfolio companies can suffer. So for us, it's a constant battle daily, I would say, of spending our time wisely and being good steward of time, but analyzing our time in what's going to give us the best ROI, both short term and long term, is something that we constantly have to do.
You mentioned best ROI. So based on your statistics, is it with the off-market deals or the deals through investment bankers, brokers? How is it?
I think it's a combination of all of it. I would say more of the investment bank deals and investment bank led processes. Those are where we're getting plugged in, and then we're in the process, and that's the potential acquisition for the next 3 months or 6 months or year, versus this guy may be ready to sell this year or maybe next year or the year after. So I think it's a combination of all, but the most immediate has been in the pursuit of investment banking deals.
Now, again, relationship-driven sourcing. If you can go more specific, like how do you think about the long game of relationship in deal sourcing? I mean, those business owners, they're busy, they're running their firms, they have those daily problems, and then there is guys like you calling them, sending emails. What have you seen works best? Do you send them like happy birthday, like the names of their kids and cats, and you sending them messages, or how does it work? How does a professional like you work?
Yeah, I think some of the best advice I got when we launched the firm was just this industry is very transactional, but it's also very relational at the same time. It's you're there to have a transaction take place, but you also want to buy and sell from people that you have a relationship and you have a connection and you have rapport with. And so for us, it's building that relationship, but not artificially. I think it's very much like authenticity really shines, and making that connection. And it's not like, hey, how's the weather today? It's like, hey, we talked 6 months ago, and here's where you're at, and how have things progressed? How was that project? How was that expansion plan? And keeping it relevant, right? So it's like we're not trying to be their best friends. We don't need to be their best friends. They don't want us to be their best friends, but we do have to have some level of rapport and some relationship. But for us, I always take the relational consultative approach to BD and originations. It's you want to buy from people that you like, know, and trust, and you want to work with those people, versus you can sell anything or to anyone and you can buy anything from anyone, but really think about the best experiences that you've had in any transaction. It's really been people that you like, know, and trust, and that takes time to develop. So that's not built overnight.
Can you share any examples where like a deal came from like an unexpected or a long dormant connection, something you've done maybe long time ago? You created a specific luck and now it just like happened.
Yeah, and we have a whole strategy around that of understanding deals that maybe didn't materialize, or ones that we didn't get to the finish line on, that we still keep an eye on it until we see a deal announcement, and until it's transacted, like there's still opportunity, and those are some of the curveballs and challenges of seeing a deal die and then come back to life. But there's been a lot of deals where we've said, hey, this is where we think the value is. And the banker may say, no, I'm here. I think we can get significantly more value for that, for this business. And then ultimately, they come back to us and saying like, hey, you were right on the value. Or it's, for us saying to them too, it's like, hey, if you can go get that multiple, go get it. Good luck and God bless on that front. But for us, it's like we have a certain disciplined view where we think this business is worth X, and then sometimes usually it comes back to our view on it.
What excites you most about the lower middle market right now?
This is probably a crazy answer, but I think some of the instability actually. And, when we started the company, when we started Woodson, 3 years ago, it was every conversation I had was about interest rates. And then in year 2, it was all about the election. And then in year 3, it's like, I'm sure you've heard all about tariffs, right? So it's like the instability, I think, creates an opportunity for us. It's not that we're contrarians or take the contrarian approach, but I think any volatility or any instability really helps produce opportunity for us. And so for us right now, the exciting thing is, how we're viewing tariffs and leaning in on certain deals where other firms may be more comfortable sitting on the sidelines.
What is something you and your team may be currently struggling with? Let's say we end this recording and you start working on it immediately. What is it today?
I think for us, it's a matter of bandwidth and scale. And, like I said, we have our version 1.0 of our current team, and then we also have our version 2.0 and 3.0 mapped out of what this looks like. So for us, it's a matter of bandwidth and scale and picking our spots correctly, right? So it's like 99% of the deals that we're going to see are not going to be a fit, or, not 99%, but, a high percentage of deals that we see are not necessarily going to be a fit or a Woodson deal. But I think for us, it's a matter of, scaling up our team, and then so that we have a whole strategy and plan developed around that.
Your thoughts on risk, and to be more specific, your view on this debt and equity ratio when doing all those deals.
Yeah, I know, obviously private equity gets a bad rap on, over leveraging certain companies and deals, but, for us, each deal is different. And so, for us, we're going to structure it the right way that makes sense for all parties. And so for us to be able to get the deal done, and also it has to be a win-win for everybody involved. So, the way that I answer this question is generally that it depends on the deal and the nuance of the deal. We generally have a certain ratio that we strive for, but it's largely going to be dependent on the deal.
You see a lot of different businesses, a lot of operators, good operators, great operators, not so good operators. When you think of best operators you've worked with, you've seen working, what patterns stand out?
It's a good question. For us, the reason we're named Woodson Equity is actually a nod to Detroit, Woodward Avenue and Jefferson Avenue in downtown Detroit. And the reason I bring that up is VJ always, came from automotive background. And says that the best operators are former automotive guys. And part of that DNA, I think, is just there's preparation, there's focus, and then there's discipline and diligence. And so I think that's really been what separates the good operators from the mediocre or the bad is the preparation. Can you just show up and wing it, or are you prepared? Are you well read and studied on industry trends and what's going on in your company, internally and externally? I think preparation is big, and I think the discipline of doing the follow-ups and staying on top of anything that you're touching with the right reporting and the right people in place and getting the right people in the right seat, I think are all big elements. And so for us, core elements of not just a good operator, but also Woodson is there's curiosity. There's obviously, you want to be curious about what's possible and where we can take the business and how you can grow it. And then, there's a level of integrity like that cannot be compromised. And so, we always say that, we want to be able to do things the right way and operate with integrity. It's who you are when nobody's looking, and those decisions that are being made. And I think tenacity also is a big one for us too. It's like, we love that underdog story where, it's not, we don't look and feel like a traditional PE firm, I think. But the tenacity of like, even if a deal dies on us, like it's not over until it's over. And just the ability to keep fighting, keep going, and keep pushing in every facet of our firm.
You have lots going on, new deals, current portfolio companies. How do you get better? How do you like improve your investment strategies and yourself as a person to be ready for future opportunities, future threats, future everything?
Yeah, I mean, I think it's a mindset of never settling and understanding that any deal at any point can blow up, and even you can have a great company and it's one decision, you're one bad decision away from all of that going away. So it's constantly living with that tension of never settling and always continually we have to improve, otherwise our competitors and the market's going to improve and we're going to be left in the dust. So for us, it's a mindset of continual improvement, and also knowing that a lot of these things are temporary, like that they markets can change, industries can change, people can change. For us, it's a matter of never like just getting comfortable. We always want to have a healthy tension or discomfort in what we do, and that pushes us to continually try to innovate.
There are lots of tough times, I guess. Things don't go as planned. How do you recover and how do you prepare yourself for the next sprint, if we can say that? If things are going like, if it's really tough out there.
Yeah, I mean, we've had those seasons too, where and I always say that things go in waves, like both good and bad. And all of a sudden, like three deals come in place, and we're moving along, and then all of a sudden, three deals die. And for us, it's I think not getting too high on the highs and not getting too low on the lows, and just working our plan. Like every day, we're going to show up and we're going to do the work, and we're going to keep the firm moving along. And I think that has been the key, both in the good and the bad, of never getting too happy or complacent when things are good or comfortable, and then also never knowing that some of the down periods are temporary, and if we work the plan and we do the work, good things are going to happen.
Now, maybe there are some founders listening who maybe consider selling their business, and they have people like yourself reaching out to them. How they can maybe best prepare their companies for a successful sale to a business, to your business, Woodson Equity?
Yeah, I think for sure financially being buttoned up on the financials, and that's what we've seen on a lot of small businesses is you have the nephew or the niece or the granddaughter running finance or the books, or just having consistent and credible financials. I think are really really like sets it apart, sets a good company up from a bad. And so I think having some level of reporting, some level of management structure in place, so that it's not all dependent on the founder or the leader, so that there's a scalable system in place, I think are two big things. Because the downside of that is the financials are a mess. Like it's going to be months of work to even get a view or understanding of the business. That for us is a flag that we would rather work with a company or buy a company that has tighter financials. And then the second is, the second point of what I said is if it's just one guy who's the main guy, who's the key man, who everything revolves around, there's a certain risk to that. So for us, we need to have, we like to see scalable, stable management teams that if something happens to that leader or that president or CEO or founder, like the company will run without them.
Can you share any war stories from your deals, maybe buying, growing, selling, etc.?
Yeah, I mean, there's a lot. I mean, some of the advice that I got early on is that any deal will die, 7 times before it materializes. So it was hard to fathom, but I witnessed it on multiple deals. It's just like, nope, it's dead. It's over. And then it comes back to life. Something changes, or a conversation is had, or something changes on our end, and then it comes back to life. So for me, it's definitely like it's that roller coaster of there's just many things I can share on that front of, like, all of a sudden a deal looks great, it looks promising, and then hey, it's dead, it's not going to happen. And then the opposite of it too, it's dead and comes back to life, and now it's up to us to do the work to get it closed.
Does it still hurt as much as it used to in early days when you didn't have this experience yet?
Yeah. I mean, when I was working in media in at CBS, something in the manual that stuck out to me was it was like the onboarding and training process, and it said hate losing more than you like winning. And I didn't really get it at the time, but winning is like an expectation. Like we expect to win the deal and close the deal, and then losing hurts because we're expecting to win. That's the bar, that's the benchmark and the baseline. So for us, yeah, it still hurts. But it's better because we have more opportunity and more things going versus all eggs in one basket. So for us, there's a little bit of risk that's hedged now, but hey, we hate losing. I mean, we're all very competitive, and there's no cigars for second place. So for us, we wanna be in that lead seat.
That said, what's next for you? What's next for Woodson Equity if we take the next maybe, let's take 2 or 3 years because a lot can happen in this short period of time. What's next for you?
Yeah, I mean, 2 to 3 years, I think, puts us at the end of this current administration. So navigating that and navigating some of the volatility, the short-term volatility that we're seeing, I think, working the plan of a certain amount of acquisitions and deploying a certain amount of capital, and then continuing to operate our portfolio. And then I think within 2 to 3 years, there should potentially be an exit for one of the portfolio companies at least. So I think that's what the next 2 to 3 years looks like. And then I think team expansion too. Like I mentioned, we've got a whole 2.0 version of the team that is slated and ready to go and people identified. It's just a matter of flipping the switch and making that happen. So I think team expansion, I think, navigating the current geopolitical climate, and I think also just continuing to buy great companies and to optimize them.
2 wrap-up questions, Joel. Number 1, what is your favorite book?
I'll give you one that I read this year that I think has transformed my thinking, and it's 10x is easier than 2x. And we think about growth in this like, oh, I'll grow 10% this year, 50% this year, or maybe I'll grow 2x, but just exponential thinking around going 10x and what it takes in focusing on the 20% of activities that are producing the bulk of the revenue or activity, I think was big for me. So I think 10x is easier than 2x is a book that I read this year that has really opened my eyes on certain things as far as growth and setting goals.
You've worked with many great investors, met with many great investors, operators. So what is the best investment advice you've ever heard?
I will tell you a story. We met with the CEO of Stellantis Financial, and just a great guy. We met with him at his office down in Texas, and he said there are no bad deals. There are only bad prices. And so, there's like if you get a company for the right price, it can go to a good deal pretty quickly. So, that was one that I think is a story that I remember as far as the way that we look at deals, because it's like often saying like, hey, this is a bad deal, but like, what if we got it for the right price? Then that bad deal becomes a much more attractive, desirable deal.
Okay. I have plenty of notes from this call. Thanks a lot for doing this fascinating business, fascinating portfolio. I hope to do it again in a future to see how it all end up and where you're heading next. So thanks a lot for doing this, Joel.
You got it, Mick. Thank you.
Okay, I stopped the recording. Thanks again. I was a bit like afraid to ask more about the portfolio because what you said in the beginning of the
It's fine. No, it's good. I think you hit on a lot of the good things, and I kept it high level on certain. So I think it was good. So you feel like you got enough good content there?
Yeah, of course, 100%. It went all the places, all the different questions, follow-up questions, but I think we covered it all.
Yeah.
I appreciate that you shared the things in the beginning of the call. Otherwise, I would maybe go more specific
Yeah.
with the portfolios. That's great that you brought it up.
Yeah.
And
Yes.
I'll post it. Yeah, keep going.
What is the typical turnaround time for editing and the next steps?
Do you have like do you prefer anything, or
Oh,
why I'm asking is because summer is coming, so I'm doing some of those for the future. At the moment, I think it's episode 7 or 8, so I might post it in second or third week of July if that works.
Yeah, that's fine. I mean, we don't have any timeline on it. I would just like to see it, or at least get a preview of it before it goes live, just to quality control it. Yeah, so that'd be.
I'll take a note here, and I'll send you the ready version before it goes live, so you can get feedback, or if you want to make any change.
And our team to hear it just before it goes out, just because they're, some things are more sensitive than others.
Of course. Okay, again, awesome story. As I said, happy to do it in the future again, and thanks a lot for doing this.
You got it. We'll talk soon. Thanks, Mick.